Welcome back to the channel, everyone. Today I want to talk about the SEC finally stepping in and doing something, as they've just charged two individuals for a fraudulent trading scheme involving meme stocks, although unfortunately it's not quite as perfect as we might have hoped. So stay tuned and let's make some money. But before I dive into the video, if you haven't already, be sure to sign up to Moomoo using the special Thomas James investing promotion. Not only do you get a free stock worth up to $350, and not only do you get a second free stock with a guaranteed value of $50, but you also get a third free stock with another guaranteed value of $30 on top of that. All you have to do is sign up to Moomoo and deposit at least $100 to get those guaranteed free stocks. You could also sell those free stocks and get 2 entirely free shares of AMC just for signing up and depositing. Linked in the description below. And I want to dive straight in with the key information. So, let's start by reading through the SEC press release, and then I'll go on to explain why it's not quite everything we'd ever hoped for. So the SEC charges two individuals for a wash trading scheme involving options of meme stocks. The SEC today charged a Florida resident and his friend for engaging in a fraudulent scheme designed to collect liquidity rebates from exchanges by wash trading put options of certain meme stocks in early 2021. According to the SEC's complaint filed in February 2021, Soy and Gu became aware of the increased market volume and volatility driven by so-called meme stocks. Gu allegedly then devised a scheme to take advantage of the maker-taker program offered by exchanges by trading options of these stocks with himself. Under the maker-taker program, a trade order that is sent to an exchange and executes against a subsequently received order makes liquidity and generates a rebate from the exchange. In contrast, an order that is immediately executed against a pre-existing order takes liquidity and is charged a fee. The SEC's complaint alleges that Gu was able to generate illicit profits by using broker-dealer accounts that passed rebates back to their customers to place initial orders on one side of the market, and then using broker-dealer accounts that did not charge fees for taking liquidity for his subsequent orders on the other side of the market. So he was basically using two platforms to trade between himself. He was using one platform that generated rebates for himself and used another platform that would usually charge fees, but he found a specific platform that did not charge fees. When identifying a product to trade, Gu and his friend and business associate, Yong Lee, selected far out of the money put options on some meme stocks, which they thought would be easier to trade against themselves because interest in buying the meme stocks and related price increases would make put options on these stocks less attractive. After certain broker-dealers closed Gu and Lee's accounts in early March 2021, Gu was able to continue the scheme through mid-April 2021 by lying to broker-dealers about his trading strategy, using accounts in the names of other people, and accessing these accounts through virtual private networks or VPNs to hide his activity. The complaint alleges that Gu executed approximately 11,400 trades with himself, netting at least $668,000 in liquidity rebates, and that Lee, his friend, executed approximately 2,300 trades with himself, netting $51,000 in liquidity rebates. In addition to collecting these ill-gotten rebates, the wash trading scheme allegedly impacted the market as it skewed the volume in certain option contracts and induced other traders to place trades in otherwise illiquid contracts. As alleged in our complaint, Gu and Lee engaged in a deceptive wash trading scheme to game the exchange's maker-taker programs and take advantage of market conditions associated with meme stock trading. This case demonstrates the SEC's ability to quickly investigate and expose complex trading schemes, including those conducted during times of significant market volatility. The SEC's complaint charges Gu and Lee with violating the Securities Exchange Act. Lee got a $51,000 fine and $515 in pre-judgment interest and a civil monetary penalty of $25,000. And the SEC's litigation against Gu is continuing. Now, there is a few good points in this press release and a few good results that I noticed as well, so let's talk about them. Now, the first one, which is a downside, is that unfortunately this is not the SEC charging Ken Griffin and Vlad and sending them both to prison, and disbanding Citadel, ordering them to cover their short positions. No, unfortunately, it's much more small fry than that. They've gone after two individual people for wash trading. There's a quote that I was trying to find from the Wolf of Wall Street, but unfortunately I can't find it. but I'm sure you will remember the scene where Jordan Belfort directs the SEC investigators into that freezing cold room in his office. And he says while those SEC investigators were looking for a smoking match inside his office, he was letting off a bazooka in the room next door. And that is exactly what's going on here. Gu and Lee were lighting that smoking match while Ken Griffin is letting off a bazooka right under the SEC's noses. However, something that is slightly positive is the chief of the SEC's Market Abuse Unit said that this case demonstrates the SEC's ability to quickly investigate and expose complex trading schemes. And therefore it shouldn't be beyond the SEC's capability to quickly investigate and expose the complex trading schemes going on against AMC stock, all those short ladder attacks and naked shorting. And something else that is slightly positive is that Lee actually got a fairly big fine. He generated $51,000 in profits and was made to pay back those $51,000 and an additional $25,000 on top of that. So potentially for once in the SEC's history, somebody has actually lost more money in fines than they made in profits. Typically in the past, we've seen large corporations make billions and billions, tens of billions or hundreds of billions of dollars in profits and only pay a small fine of a few $1,000,000. And it does also show that the SEC are actually doing something and investigating meme stocks and the sketchy practices and sketchy trading schemes going on behind them. And we also know that there is an investigation going on to the excessive short selling and trading of put and call options in AMC stock and GameStop stock as well. Obviously this was disclosed in the GameStop Q2 financial statements and on the AMC website a couple months ago. So hopefully the SEC are getting to the bottom of this investigation and will be bringing some criminal proceedings against Ken Griffin and others like Vlad Tenev. And I also wanted to quickly touch on and talk about the hashtag Ken Griffin lied. I think this is a brilliant movement as it brings more media attention to the fact that Ken Griffin lied under oath. If this can remain trending on Twitter for the next few days and the next few weeks, then it will bring far too much media attention to the topic for the SEC to ignore it. Now I have seen some tweets about Twitter suppressing or removing the hashtag Ken Griffin lied and removing it from trending, but I'm not 100% sure that that's exactly how Twitter works. Twitter does work in very funny ways. Sometimes it shows things as trending when they aren't, and sometimes it shows things not trending when they are. And sometimes it will show it as trending on my screen, but won't show it as trending on your screen, for example. But it will show it as trending on other people's screens as well. I don't really think the Twitter algorithm is 100% perfect. All I know is that this was trending, and I do believe that it still is trending as well. Even if it is removed from the trending page, I think it's important that we continue to post the hashtag Ken Griffin lied. If I post this hashtag, then my followers are going to see it. And if my followers retweet my tweet, then their followers are going to see it as well. And then if their followers decide to retweet it onwards as well, then there's another line of followers that continue to see it. And therefore, even if it isn't necessarily trending, the retweets upon retweets upon retweets upon retweets will continue to spread the message. And I also wanted to touch on Evergrande as well. We've got a tweet from Unusual Wales saying, breaking news, Evergrande's chairman pocketed $8 billion in dividends during the Evergrande collapse, while forcing employees to lend the company cash, as well as freezing their pay. I think that is absolutely atrocious that the chairman was stealing money for his employees and using that money to pay himself out some dividends. And it also looks ever more likely that the Evergrande collapse is approaching us hour by hour. Now I also wanted to go through some additional due diligence by the last best standing, banks in theory and in practice. Theory. Banks play a crucial role in a country's economy. They take money that is not currently being used and lend it to others. Through extending credit, they are allocating resources, but importantly, they are also responsible for assessing the value of capital they have lent. Example, a bank lends $100 and that money is used by the borrower to generate value. That ensures the bank is repaid the $100 with interest. But that doesn't always happen. It's up to the bank to constantly reassess the value of that loan and the likelihood they will be repaid. In accounting, this is called valuing something at fair value or just recognising provisions against any doubtful receivables. Taken in aggregate, banks are the bookkeepers for a country's credit expansion, ensuring that credit leads to productive growth and bearing first losses for bad debt, When done properly, this creates a market-based structure of healthy credit expansion and economic growth. Although accounting is a description of reality and it does not dictate reality, Evergrande never reported a loss but is insolvent. Similarly, whether a bad loan is properly recognised does change its ability to be repaid. Losses are incurred whether or not they are recognised. In accounting, if you've given a loan out but you know you aren't going to receive it, you should obviously really write off that loan because you aren't going to get it back. But in accounting, you can still leave that loan there at full value, although you really shouldn't, but it does happen more often than not. When banks conceal losses, it adds to systemic instability by misrepresenting losses to shareholders, counterparties, regulators, and society in general. This compounds the problem by allowing asset values to remain overstated and capital continue to be misallocated, or capital continues to be misallocated. Banking failures occur when losses are recognised, as in recognised with the accounting, and not when they are actually incurred. In the US, shoddy subprime loans fueled overinvestment in housing and inflated housing prices from 2003 to 2006, but banks failed years later when they were forced to recognise these losses. In practice, the losses of unproductive investments in China has already been incurred. The country's collective resources have already been spent on rebar and cement for unneeded housing, whose market value depends on continued expansion of debt to citizens to buy them. This reality cannot be undone. The money was already spent. The fact they incurred losses to date have been concealed, which makes matters much worse by overstating the health of the financial sector and housing prices in China. Consider the following article on bank responses to Evergrande's missed payment. AG Bank has made some loan loss provisions for Evergrande's debt. Meanwhile, Minsheng and CITIC have agreed to roll over Evergrande's near-term maturities, and therefore have not recognised that write-down or provision on the debt. The three banks likely have the same recovery prospects for their Evergrande loans. The difference is that AG Bank is recognising these losses that others are pretending have not occurred, perhaps because the impact of the smaller banks is much more significant. Now consider the overstated value of inventory on the balance sheet of all property developers. One man's inventory is another man's collateral. The ability to monetize this inventory is near zero, and the process of liquidation crushes the real estate market and spreads contagion. And the reason why Evergrande did not write off this inventory earlier is because they wouldn't have been able to get loans if they had written it off. The fact that they overinflated those assets meant that they could borrow more debt against that overinflated asset price. And this is also what's going on with Chinese banks as well. They're still recognising those massive overinflated loan recovery balances that probably aren't recoverable, just so they can get more loans themselves to give out more cash and create more loans that they're giving out as well. And this is effectively a vicious cycle where the Chinese government has stepped in by setting those new ratios and rules, and therefore that's why we're seeing so many property developers in China, and potentially banks as well, starting to be in a lot of trouble. Guys, be sure to let me know down in the comments below what you think about the SEC actually taking action and issuing some fines. And while you're down there, be sure to sign up to Moomoo using the special Thomas James Investing promotion. Sign up, open the account, deposit at least $100 and get your free stocks. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.